We are back talking about Kenya's public debt. We are capped at 50% as far as the Public Finance Management Act 2015 is concerned. We're about to tinker there. We're at 48%. There are proposals from Treasury to actually move away from capping us at a percentage of GDP and rather working with an absolute number. The number that we're looking at is 9 trillion. Now, Churchill Ogutu is a senior research analyst at Genghis Capital. And before we took the break, he just told us if we look at 9 trillion, it would take us up until 2024, 2023 to get to that level. And hopefully by that time, our economy, or rather the value of the GDP, could possibly be 14 trillion. He has some very interesting thoughts with regards to what is the feasibility of this number. Now, before we took a break at Churchill, we were just discussing, okay, there's the pros and cons of whichever dimensions that we use. But the key question here is the sustainability of this and the element of having a huge list or a long list of government infrastructure projects that have not been fulfilled, but they've already been allocated for or budgeted for in the current budgets. You did say that we need to go back to the basics when we're looking at debt at a national level. What do you mean by that?
As I was explaining, in terms of the revenues that we have on board, we need to be a bit realistically with our targets, because we find that where the rain starts beating us is having ambitious revenue targets, and the revenue targets, that's where we more or less is like the core revenue pool, and then any surplus comes from the debt financing. So we find that the moment we don't hit our revenue targets, we just dig more into the debt, dig more into the debt, the debt pool of it. Yeah.
Okay.
So I need back to where I started from, which is a bit a long haul, having the budget balance. If that's not the case, we just need to reduce the fiscal financing in any given year in absolute terms, rather than having it in percentages, which we are, as experience has shown us, we're just kidding ourselves.
We're just kidding ourselves.
Let's just have a reduced fiscal deficit, and that will now imply that we have some fewer infrastructural developments in any given year,
okay,
but at least which are quite feasible, not stretching ourselves thin.
Okay. Yeah. So it feels, I mean, if I look at it, I imagine if I was running a house, or I do run a household, but it feels like you're in a space where you have to meet your grocery expenses, you have to pay the people who work around your home. There are things that you have to pay for each and every single month, but then the revenue that's coming in is not sufficient. So it does feel like I'm actually running a credit card on an overdraft system where I keep expending and paying with my credit card, and anytime money comes in, I use it to pay back. But then on the other hand, I still have this grand projects that I want to do and I need to do if I want to enhance my revenue capabilities in the future. How do I balance this? I mean, I'm speaking from a micro household. I would first of all stop any infrastructure spending, try and find a way of reconfiguring my expenses before I move on. Otherwise, I keep just digging a hole and digging a hole. But maybe the governments have luxury because they don't have an issue with regards to a going concern. They come, governments are there, people change, but they continue. How do you look at it from a national level?
This thing we call original sin,
original
whereby
sin.
You borrow in foreign currency.
Yes.
And then it has to fund things in local currency, and then you still have to pay back in foreign currency. So you find there's a bit of some currency mismatch, because locally the money mostly from the external fund that you get is on foreign currency, but yet they are going to fund development projects in local currency. So by the time you are going to service those loans,
yes,
service that debt, you have to ensure that your currencies, at least first of all, that the revenues are there, and also that at least there's not much of depreciation in local currency, so that you don't end up paying much more. So
that brings me to foreign currency.
Yes.
Then how do we look at it? Because I want to imagine that you do speak to local investors as well as global investors. So if they're looking at this economy and there are all these problems with regards to the sustainability of the public debt, what are your thoughts with regards to the risks associated with the currency?
Yes, that's also where I was driving at here. Because find that we just back to the basics.
Back to the basics.
You find that right now we have this whole the Big Four agenda in terms of even supporting some of the local industries, the manufacturing, even to an extent agricultural front. But I find that our exports are still the traditional tea and coffee, which are still subject to the gyrations in the world market. Right now, in the beginning of the year, we had the drought impact, delayed rains, and it has tanked even the production of both tea and coffee, which are mostly the traditional agricultural products. So I find that what we are getting eventually is quite much lower, the exports. But still, the exports is what we rely on to build the buffers so as to be able to pay the debt, external debt.
In essence, we're actually depending more on our diaspora remittances as opposed to depending on our exports.
Yeah, and diaspora remittances are they're not quite stable as such, because they are dependent on different, on the foreign countries rather than ours. So there should be a real focus on even a shift, not only from the traditional products, which are more or less primary products, but you can have some value add, not just relying on that, but you can also develop some of the industries so that you can be able to build the exports. With that, in as much as we are getting, on the one hand, we are getting the foreign borrowing, at least you have something to buffer us as a country, and we'll be able to pay back that debt, and that all lies in the sustainability of external debt, because that's quite crucial. If you look at the public debt, the most crucial bit is now on the external side.
Yes.
If we are able to have some buffers on our side, that's quite critical, and that should be the focus priority. In as much as you're pursuing this, the Big Four agenda, that should be the overall.
That's where we need to stand. But here's a contrarian view. Why not just say, stop taking out more debt? What would that mean? Because, I mean, we keep having these issues, we're going around in circular motion, okay, it's a percentage, it maybe needs to be an absolute figure, we're still borrowing, and we're borrowing to service our recurrent expenditure over and above our infrastructure spend. We are borrowing from the local market and the foreign market. Rather than saying, this is what we need to do in the long term, what's the worst thing that would happen if we took a hard stance and said, don't borrow till you fix what you need to fix?
Yes, that's quite an extreme move. I mean, we'll be biting more than we can chew if you go that route. Because ultimately, unless you go to whereby there's a balanced budget, our revenues, whatever we get, if it's 1 trillion, and then we can now be able to do expenditures based on that 1 trillion in terms of the revenues collected domestically, that's the best way to go. But because of the strategy in terms of infrastructural development that have been prioritized, we cannot run away from the public debt. But now the issue is now on the sustainability around it here. And if I may just mention, even more in line with the public debt pronouncement that came from Treasury, there's a bit of some openness that Treasury is trying to inject in terms of moving away from the 50% of NPV and now going to a hard 9 trillion shillings public debt limit.
Yes.
But then again, they say that we want to, because was to be able to access the concessional fundings from multilateral and bilateral lending. But remember that Kenya became a middle income country.
So then we don't actually get some of the benefits that we are trying to allude to.
Yes, and if you look at even the contribution on the external debt, you find that the multilateral lending as at June 2014 was at a high of 52%. Now it has gone to 32%. And commercial 32%. Financing at that time was 20%, now it's going to 36%. So there's a clear shift from multilaterals into commercial financing, and that's where the Eurobond and the syndicate loans come through. So my understanding is, this is what I'm just trying to look at it. Remember that 3 months ago, Kenya acquired a loan from World Bank, development financing policy program.
Yes.
So I think it might be more aligned to that, because there's another tranche that I believe it should come through. So they are demanding a bit of some openness. But having said that, I still believe that the last time we had an external debt register which I saw publicly was at June 2015.
Yes.
So there's been a bit of 4 years. We haven't seen a bit of some.
So we need more data.
We need more
data transparency. Okay, Churchill, unfortunately, we have come to the end of our show, but just as we clock out, do you feel like we are in a better space? Because all this that we're discussing is already known by the decision makers. In your space, when you are a senior analyst and you're an economist as well, number one, do you feel like we are getting better? Are we addressing the problem? It might not be apparent, but from the conversation that you're having. And then secondly, and the final question is, if you're an investor on equities and fixed income, based on where we are at in Kenya today, where should you put your money?
The first question, I think policymakers need to be more transparent. There's a bit of some opacity in terms of where we are going, in terms of the policy, in terms of the debt. So I think they need to be a bit more transparent so that investors could be able to have much more comfort even coming to Kenya.
All right.
In terms of the second question, I think fixed income could be a better bet, just looking at even some of the money market funds right now.
So go lend your money to the government. Will the rates come down? Because central bank has actually said that's something they are pursuing.
I think broadly, if you look at how the macroeconomic and macroeconomic developments is shaping up, find that there's a case for rates to come down. But I think they're still hamstrung because of the interest rate cap. So I think the best place just to look at, say, T-bills at the moment.
So that's the 1 year?
Yeah, 1 year.
The one-year T-bill, mostly the one-year T-bill. Fantastic. Churchill, thank you so much for your time. We certainly need to have you come back and give us an extension of the conversation that we have just had. So you've heard it. A couple of considerations. Does it make sense for us to focus on 9 trillion? Yes, and maybe no, unless we are going to get to this number in 2024. But at times we do know what happens is if you give a number, everybody will be working to get to 9 trillion faster rather than later. If you are an investor, it seems that it's better for you to actually put your money in the fixed income market, largely focusing on the 1 year T-bill. In other words, it's better for you to lend your money to the government for a return because the government does need this money. With regards to reforms, that's certainly an ongoing conversation. We do need to be able to see much bigger reforms. One of the things that we would appreciate from the investment community and from what Churchill says, we need more data transparency. From my own, I think we need to cut expenditure by more than 2%. If we could do 50% and balance the budget, that would be ideal. Again, very extreme. But the considerations are there. The government needs to do slightly more. For you as an investor, for now, maybe in the short term, look out for your fixed income assets and potentially dividend yielding assets, something that we will discuss later on in the week. Did you engage with us on Twitter? What did you think about our considerations and deliberations? What more do you want to know? Please let us know. Give us a tweet, give us a shout on either Facebook or on our YouTube pages. Thank you for joining us and good afternoon.